Welcome to the Deep Dive, the Talk Tickers edition, where we strip away the noise and get straight to the essential market intelligence.
Hey there.
Today, we are cracking open the Q3 2025 results for DLocal Limited, ticker DLO.
And this is a textbook case of market cognitive dissonance.
Yeah.
The earnings call, which was after hours on November 12th, delivered these just record financial metrics. I mean, the definition of hypergrowth.
Right.
And yet it triggered a really sharp market sell-off.
So our mission today is to understand that conflict, the gap between DLocal's undeniable velocity and the acute volatility in its core profitability.
Exactly.
Okay, let's unpack this apparent paradox, because if you look purely at the volume and revenue numbers, management had, every right to call this a record quarter.
Oh, absolutely.
Diluted EPS came in at 17 cents, which cleanly beat the 16-cent consensus.
Mm-hmm.
And revenue hit $282.5 million. That's a 52% jump year over year.
Or even 63% in constant currency. These were big beats, 5 to 8% above what the street was expecting.
And the anchor of this whole success story is volume. Total payment volume, or TPV.
TPV reached a massive milestone, $10.4 billion. That's the first time they've ever crossed the 10 billion mark in a single quarter.
And the growth itself was, almost 60%?
59% year over year, 66% in constant currency. And get this, it's their fourth quarter in a row of over 50% TPV growth. Management also highlighted that gross profit topped $100 million for the first time ever.
So you have a company delivering 50+% volume growth, growing net income by 93% year over year, hitting these huge milestones.
Right.
And yet the stock closes the next day down almost 7% after being down over 13% in pre-market trading. The market clearly fixated on one number that just overshadowed all that stellar growth.
It did.
Which metric became the existential threat to the narrative?
It was all about the margins, all of it. I mean, while the core profitability metrics were still robust adjusted, EBITDA came in at $71.7 million, growing 37% year over year.
Which is still a 25% margin.
It is, but the structure of their pricing power started to look, let's say, precarious.
So the market zeroed in on that gross margin compression.
Absolutely. The gross margin compressed to 37%, which is down from 42% just a year ago.
Okay, that's a big drop.
But the real trigger for the sell-off was the net take rate. So that's the gross profit divided by the TPV. That number slid sequentially from 1.07% in Q2 down to 0.99% in Q3.
Oof. That 8 basis point slide is huge, especially for a stock trading at a growth multiple. It suggests that, DLocal might be buying volume at the expense of profitability.
It's worse.
Or worse, that their underlying business model is just deteriorating structurally.
Precisely. That's the fear the market priced in. A growth company that starts trading down toward a 1% take rate faces a complete re-rating. You go from a high-growth tech platform to something closer to a commoditized utility.
So what was management's official defense against this fear, this idea of structural weakness?
Well, they emphatically rejected it. Executives framed the take rate volatility as being entirely driven by mix and specific country effects, not some long-term failure in pricing.
So temporary issues.
Temporary issues. They acknowledged there's some competitive discounting in peak seasons, but they pointed directly to specific geographical headwinds as the primary culprits this quarter.
Let's get into those regional headwinds, because this is where the complexity of operating in volatile emerging markets, DLocal's whole business, really comes into play. It sounds like they're playing whack-a-mole with regional policy risk.
That's a good way to put it. They identified 3 main pressure points. First, Mexico.
Okay.
Margins were hit, and TPD growth slowed there because of 2 specific issues. A mix shift toward a certain alternative payment method, or APM.
Which is just any local payment method beyond a credit card.
Right. And critically, new import tariff hikes on low-value parcels. That is a direct, sudden policy shock hitting cross-border e-commerce.
Wow, that tariff shock directly attacks their bread and butter, those cross-border transactions. Then you have Argentina, which is, it's always a watch point.
Always. Though management was quick to point out it was only 12% of gross profit this quarter, so their diversification is increasing.
Still, what were the issues there?
The issues were lower interest rate spreads, some temporary higher processing costs, and a few non-cash inflation adjustments. They did say TPV started picking up after the election, but FX volatility is still a short-term risk they're tracking.
And the third region that's still causing some pain?
Egypt. Management acknowledged that the wallet share losses we heard about back in Q2 continued to pressure the Q3 results, especially in the advertising vertical.
So if you put it all together, Management is telling the street, look, we are dealing with specific temporary regulatory issues in three small parts of our ecosystem, not a company-wide inability to execute.
Exactly. And that emphasis on execution is key. I mean, the volume strength must have been massive to hit $10.4 billion TPV despite these regional drags.
So where did that growth come from?
It was impressively broad-based. We saw explosive growth in frontier markets like Colombia, Bolivia, and Nigeria.
Wow.
And that's alongside sustained strength in their core verticals in Brazil. So streaming, e-commerce, digital pay-ins, the engine is just running on all cylinders, which makes the valuation hit even more.
What really dictates the moat for a platform like DLocal is its ability to grow within its existing customer base, which brings us to net revenue retention, or NRR.
Yes, the number that tells you how sticky and essential they are.
And that number.
It hit 149%.
149%. Just think about the implications of that. It means their established merchants, and this includes 6 of the biggest global tech companies, increased their spending with DLocal by almost 50% year over year.
It's a powerful testament to the platform's role as that indispensable infrastructure layer for global enterprises trying to get into emerging markets.
So what does that 149% NRR really tell us that the market is ignoring right now in its margin panic?
It tells you 2 critical things. First, once a global merchant integrates DLocal, the switching costs are astronomical. They're deeply, deeply embedded. Second, as those clients grow in emerging markets, DLocal automatically captures that growth plus more because they keep offering new services to those same clients.
So that NRR suggests the platform's value higher conversion, local expertise is still totally intact.
Completely, regardless of the temporary FX noise.
Speaking of new services, let's move beyond just scaling payment pipes and look at their strategic product innovation. Their move into buy now, pay later is really intriguing.
Yeah, they highlighted their proprietary BNPL aggregator, which they cleverly named Fuse.
Fuse, okay.
It's designed to solve the fragmented credit landscape in these markets. It's already live in 6 countries and saw, pretty impressive 2.5 times quarter-over-quarter volume growth. Still in its infancy, but growing fast.
That's exponential growth.
Yeah.
But BNPL usually introduces massive credit risk. Is DLocal taking on that risk exposure?
And that's the key distinction and why the market should see this so positively. They take 0 credit risk.
0.
0. DLocal partners with local banks or credit institutions and deploys Fuse with a revenue share model. They handle the aggregation and the payment flow, which actually generates a higher take rate than a standard pay-in without exposing their balance sheet to consumer defaults.
It's a pure infrastructure play.
Exactly. And it's designed to stabilize and maybe even lift that pressure on the net take rate over the long term.
Smart APMs were another highlight. Can you give us an example of how that conversion boost actually translates into real value for a merchant?
Absolutely. So they now have APMs on file capabilities across 27 local payment methods in 16 countries. The example they gave was in Peru. By tokenizing the popular local payment method YAPE, they facilitated a 34 percentage point rise in conversion rates for the client.
34 percentage points. That is a massive number. That moves the needle for a global merchant.
It's their core, sticky value proposition. And on top of all that, they're still landing major partnerships. The Western Union deal was mentioned on the call.
That's a huge name.
It's huge proof of relevance. It extends DLocal's reach into Latin American remittances and digital pay-ins. It reinforces their position as a critical financial infrastructure layer for the largest global players.
Okay, let's pivot to guidance, because after such a sharp negative market reaction, you often see companies soften their forward-looking statements. DLocal did not flinch here.
They held firm. The full year 2025 guidance, which they had already raised back in August, was reiterated. In fact, they went even further. Management now expects TPV to exceed the high end of that 40 to 50% growth range.
And revenue.
Revenue is tracking near the upper bound of the 30 to 40% range. Gross profit and adjusted EBITDA are also expected to land between the midpoint and the upper end of their ranges.
So the message from the corner office is unequivocal. The growth engine is sound, the profitability turbulence is transitory. But they were still candid about the macro risks they face.
Of course. They explicitly called out risks that we as investors have to track. The recent tariff increases in Mexico, shifting tax regimes in Brazil, though they say current proposals don't hurt them, and crucially, the potential for currency devaluations in fragile markets beyond Argentina, specifically naming Egypt or Bolivia.
Which brings up an important question. We know trading volume around the call was 2 to 3 times normal, and options traders were buying a lot of puts, betting on a further drop. Given management's very bullish TPV guidance versus the reality of that policy risk, what's the consensus narrative the market is settling on right now?
The current market read is that despite the undeniable growth and that incredible 149% NRR, DLocal now trades with a deep discount assigned to margin volatility and policy risk.
So the market is saying, we don't trust you.
Pretty much. We don't trust your claims that these shocks are temporary, and we assume that 0.99% take rate is the new baseline. What's fascinating is that DLocal has materially outperformed the broader fintech sector ETF over the last year. So structural strength is being ignored in favor of tactical margin panic.
The market sold off on fear, and fear creates mispricing. So now let's look at the numbers and see if there's a disconnect big enough for a tactical reversal.
Let's do it.
We move now to the segment where we remind you that this is not financial advice. We are simply playing the role of a hedge fund analyst pitching an outrageous but plausible tactical idea to an investment committee.
All right. Given the dramatic market dislocation following this print and the underlying growth velocity, the pitch is a reverse pivot tactical long.
Okay, a reverse pivot tactical long. Let's hear the mechanism for capturing that upside.
The idea is to initiate a bullish option spread, so for instance, a call debit spread, or maybe selling puts at a key support level, targeting a return to that roughly $17 fair value target that sell-side analysts reiterated.
And the timeline.
The target is set before the Q1 2026 results are announced. It's a bet on a technical recovery meeting structural merit.
So what's the core justification? Why should we believe the stock can bounce back 20% from these lows?
Because the market is pricing in structural decay, implying that 0.99% take rate is permanent. We challenge that.
Okay.
Management attributes the margin hit to specific temporary policy shocks, those Mexico tariffs, the Argentina spread compression. Our thesis hinges on two specific growth levers: the 149% NRR, which guarantees future volume, and the rapid scaling of that high take rate, zero credit risk product, BNPL Fuse.
And those two things should push the take rate back up.
They should stabilize or even lift the take rate sooner than the market expects, proving the compression was transitory. This is a bet that policy shocks are digested faster than feared, allowing the expected TPV hypergrowth to re-rate the stock back toward prior highs. You buy the structural story while the market is preoccupied with the transient noise.
A compelling trade idea built on a deep disconnect between volume reality and margin fear. So, to recap our deep dive, DLocal delivered record volume and revenue exceeding $10 billion in TPV and securing a 149% NRR.
And yet, investors punished the stock due to a reckoning on margin volatility, stemming from specific policy shocks in key emerging markets like Mexico and Argentina.
The company is effectively positioning itself as a high-conversion, programmatic infrastructure layer, essential for global enterprises trying to navigate the fragmented global south.
That's the story.
Which leads to our final provocative thought for you. DLocal is clearly prioritizing market share and velocity right now. Given that, how long can they sustain that net revenue retention figure north of 145%, a number you usually see with best-in-class SaaS platforms, without needing to sacrifice some of that growth for margin discipline? And what does that NRR number alone truly tell you about the platform's stickiness, regardless of all the temporary regional FX and policy noise? Something for you to mull over as you analyze the structural resilience of this fascinating company.